Let's do some Top That Trade. Joining us for that, our star players, Alan Nuckman, the Chief Market Strategist for BullseyeOption.com, and Phil Flynn, a Fox Business Network news contributor. Here we go, guys. Round number one, earnings fall fact. Earnings fell for the last quarter. So now what's the fact for the stock market?
Well, it's about perception, and they're looking in the next coming quarters for earnings to get positive, earnings growth to be positive again. But if you look at the facts since 1930, and that's a long time ago, even when earnings were down, stocks were up 77% of the time. So let's focus on facts, not how we feel here. And, you know, there's a gap up above in the S&P at 4,200. Is that gap going to be filled? That's the big question.
I think when you look at the stock market, it's a forward-looking instrument. And sometimes when earnings are bad, the market looks beyond that. And I think you had a unique situation when we compare the years in the past, just recent past, when earnings per share beat expectations and came in stronger. It was really after the COVID shutdown. We saw a lot of expectations built back in. They exceeded those expectations. Now we're seeing a reversal of that. Bottom line is it could be good for stocks regardless. It seems like a normalization of the expectations versus where the market is right now.
Round number two, hedge or hedge not. Some traders used commodity futures as a way to hedge inflation, and it became a moment. What's the best hedge now?
I think it's more of a moment. It's historical fact. In fact, I think if you go back to some of the highest inflation times in history, having exposure to commodities such as CTAs or managed accounts historically have been the best performance against weakness in a stock market and weakness in inflation. Now, a lot of people say, hey, the last couple of years, we didn't see that inverse correlation with stocks and commodities. That's because there wasn't any inflation, right? We went through a disinflation period for almost a decade. But I think you're seeing the reemergence of commodities. You really need commodities in your portfolio, especially in the situation that we're in now, where it looks like the global supplies of commodities are tighter than the demand that's going to be coming.
And I've said this for years. It all comes back to commodities. Everything's based on the underlying building blocks of commodities. And you can't say all without Al. So this is my market as well. I think gold is a great opportunity, second chance here. We had that bottom of that big bounce that we talked about months ago, where it went from 1,650 up to 1,900. And so this 1,800 is an important level to lean on. I think a second chance in gold. If you look at the all-time highs in gold, we're not that far away. But if you adjust the 1980 price, which was $900 an ounce, if you adjust that for inflation, gold would need to get to 3,600 to make new highs.
Round number three, low PE or DIV. What stocks do you like? Dividend payers, maybe 10%, or stocks with a PE below double digits?
Well, the fact again here is leaning on Mr. Buffett. Warren Buffett is all about the dividends in S&P stocks, and S&P stocks have outpaced inflation by a great deal here in history. So you're seeing that continuing growth in S&P dividends. So I know Phil's going to like all the energy stocks because they produce a great dividend. They've got upside. But I like a couple here. I like Ford, which has a PE of 6 and has a 5% dividend. And WBA, Walgreens, on every corner, has a PE of 8 and also produces 5%. So you're getting the upside potential in the stock as opposed to just putting your money in CDs to get 5%.
I think in this environment, it doesn't really matter if you're looking at dividends or PEs. It really depends on the management of the company and the story, right? And right now, the story for energy stocks is incredible. They're printing cash like crazy. They're paying back debt. And they also pay a dividend. In fact, most energy companies have been raising their companies, Chevron, for example. But if you're looking for another stock that pays a dividend, one that I like, of course, is Marshall Fields. If you want to get outside of the energy space, do a little shopping, not Marshall Fields, Macy's. I'm from Chicago. I still call it Marshall Fields, but it's Macy's. And Macy's pays a really good dividend, and it's been a consistent performer.
Hey, would you like to go to the Walnut Room when we go see Santa at Macy's? I do that every year.
I'm ready to go. I am ready to go.
On to your bonus round question for today. We're going to do some funny money. How much can a $2 bill be worth? $2, $2,000, or $2,500?
So I'm going to go in the middle and say $2,000.
I think they're only worth $2 because they had a whole bunch of them in a drawer. So Let's go. Tell me, Angie, what they're worth.
I will tell you right now, $2 bills can be worth up to $2,500 depending on the year that the bill was released. The House wins this week.
Come on.
But you guys were great. Business First AM continues right after this.